Doug at Community Lending Group. Hey, have you ever dreamt of making that last mortgage payment and being completely mortgage free? Boy, that's a lifelong dream for many. Well, I've got a tip that'll turn that dream into a reality much quicker than you think. Imagine shaving 5 to 7 years off your 30-year mortgage. How do you do that? Simple, by switching from monthly to biweekly payments. So for today's mortgage moment, we're going to walk you through this option. Now, to fully relate to what we're discussing, it helps to understand how the amortization process works. So let's say you have a $400,000 30-year loan with a 7% interest rate. That would give you a monthly payment of $2,661 just in principal and interest. Now, when you first start making this payment, a big chunk of that payment is going towards interest, as shown in the red, and only a small portion is going towards principal, as shown in the blue. But with each passing month and year, more of your payment is going towards principal and less to interest. Now, here is where our trick comes in. Using our example, rather than making 12 monthly payments of $2,661, instead set up and make biweekly payments of just $1,331. Now, by making biweekly payments, you'll end up making 26 half payments by the end of the year, which translates into 13 full payments, or in other words, you're making one extra payment for the entire year. And by making that one extra payment, it'll shave off between 5 to 7 years over a 30-year loan. And not only are you shaving off 5 to 7 years, boy, take a look at the bottom line. Now, if you take the entire 30 years to pay off the loan, you will have been charged $558,036 in interest charges. Now, by making biweekly payments, your interest charges will drop from $558,036 to just $421,358 for a savings of almost $137,000. Now, that's a lot of savings. Now, the biweekly payment works for most people because most people are paid biweekly. However, what if you're paid monthly or twice a month, or perhaps you're self-employed? Can you do the same thing? Absolutely. Just make one extra mortgage payment a year, as we just discussed. Or if you want to break it up into smaller pieces, just take your mortgage payment, divide it by 12, and make that your extra principal payment each and every month. So using our example, if you take our payment of $2,661 and divide it by 12, that gives you 12 payments of roughly $222 a month. So rather than making a payment of $2,661 each month, you'd be making a payment of $2,883. Now, the key point to remember is you'll want to make sure and indicate to your lender that the additional payment is going towards the principal. Now, there's other ways to pay down your mortgage quicker, which I'll discuss in future videos, but this is a great way to get started to drive down the principal balance and increase your equity position. So if you have any additional questions, feel free to reach out. Would love to help you. And if you found this information helpful, make sure and like the page and subscribe to this channel. It really helps me to promote this channel to more individuals. This is Doug from Community Lending, your mortgage expert, and I look forward to talking to you real soon.